Hello, welcome back guys. In this video we are taking a look at Smile Direct Club. It is a healthcare sector company, and of course we can always be using our company profile page here and take a look at what this company is. It's an oral care company which offers clear aligner therapy treatment. So it basically has to do with healthcare and specifically our teeth. And so this one has been moving a lot. You will see that the beta is very high, so it's been going up and down significantly. If you go back to our metrics page, you will see that it's sitting at about $1 actually, exactly $1 right now. And if you take a look at the 5 years chart, you will see that it has been going down and going down quite a lot, 85% since its 1 year high. And it actually used to be even higher than this if you take a look at the previous years, significantly higher. So it may be an interesting opportunity after having gone down so much, or maybe it's still overvalued. Let's take a little bit of a closer look at what the company is doing here financially. Now, of course, we're going to be examining the metrics, and you will see that we have a sea of red here, which is always not a nice thing to see, of course. The only good thing is that the revenue of the company has been growing, but last couple of years or so has been staying rather stagnant. This is obviously not a great sign for a company that is a growth company, and if you overpay, you do still want it to be growing tremendously, because this is how you will potentially get your money back if you ended up overpaying in the first place. Now, the thing is, the P ratio of the company is sitting in the negative, and take a look at this chart pretty much. It's been getting a little bit better, but it is still in the negative because the company is not making money. And the same thing with the price to free cash flow over here. The company is also, or has been actually, issuing shares, of course, since 2019. Then in 2021, kind of stopped a little bit. You will see that the slope is going a little bit linear right now. And overall, you will see that it makes a ton of sense, because if you take a look at the last 3 year chart, for example, over here, you will see that the company was having its highest price over here and was significantly overvalued. Again, you can kind of already see it here in the price to earnings, where the company was still not making money, but this was much lower over here. So getting a little bit better, but still not positive in terms of its cash flow, and that's a bad thing, obviously. Now, you will see that the net income growth is going into negative territory, which is another bad thing to see. Because when you are buying these kinds of companies, and again, you may be overpaying potentially, and it is a mistake, of course. But the thing is, if you are buying these companies where they could be growing, you need them to at some point reach profitability, or you need them to be doing something better over the years, and revenue doesn't do it still for this company. And free cash flow growth is also growing into negative territory, although getting a little bit better. You will see that in 2017 it was actually better for the company, both in net income and free cash flow. So if you bought here thinking that the company will be doing great in the next few years, guess again, they actually did worse, and it's only the revenue that actually grew, but they still kept losing more and more money, and that's obviously a very bad sign for a company. And still their equity growth is in a negative territory, even though they have been issuing shares over here. And this means that they will keep issuing shares or get extra debt here. The debt to equity is already very high and keeps growing, because if you're not making money from your operations, you have to fund yourself somehow. And there's two ways. There is only outstanding shares that you basically print and give out to shareholders, like virtually, of course, or getting debt. And so this increases your debt to equity. And especially with equity going down, this gets decreased more and more. Now, you will see here that the price to sales is 0.2, which means that the company is actually pretty cheap compared to the revenue that it's doing. And that's one of the best things about this company, if not the best thing about this company. But there are other stuff that need to be getting better over here for the company to be making sense for an investor. Now, if we take a look at the financial statements here, you can kind of see the income statement and see what I've been telling you, that the company's revenue has been increasing. Yet, if you take a look at the net income here, it's going into negative territory and it stays there. It doesn't get better, and it's going from like minus 74 to minus 100, minus 78 to minus 100. It's kind of sort of like a cyclical pattern when it never really goes into positive territory and goes back to negative again. And in terms of its balance sheet over here, you will see that while the company has been printing quite some stock over here, that's additional paid in capital, you will see that still their equity is actually growing negative right now, and that's because, of course, they are not making money, and they have quite a few liabilities, about $1 billion over here. In terms of their free cash flow, it's likely going to be negative as well. Now, the net income is negative already, and even after some adjustments, we are still looking at negative operating cash flow, which takes us to even more negative free cash flow after extracting the capital expenditure. So this company is extremely risky for potentially buying over here, and it's not really making money. Now, is there something to be said about the very low price? Because remember that, again, this was like $1 from something like 18 at some point. So again, if you go back to our max chart over here, which is this one because this is a relatively new IPO, you will see that the company in its IPO days was like near a 17, and right now it's actually one back. So think about this one, and financials were not much better than what they are today over here, if not worse, really. Actually, they were making a little less revenue, so probably we're a little bit better right now, but it was extremely expensive over here. But right now, sitting at a very price to sales ratio, maybe deserves a chance. What we're going to do is kind of take a look at our stock evaluation tool because it can tell us a few things about the potential price of the stock. Now, you will see here that the company's revenue growth has been increasing quite a lot lately, although the past couple of years haven't been great, but overall they have been increasing fairly nicely. So let's just go something like 10, 15, and 20 here. And in terms of the net income is where the big problems lie because this has always been negative. So the company hasn't been achieving profitability. What we're going to do is assume that the company reaches some marginal profitability, so they finally manage to get some money out of their operations. This has to be assumed because otherwise a company that never makes money is not worth anything. It has to be making money at some point, and if our price here, our projections, give us a very low, or I should say a green price here and a very low price to buy, then it may be an interesting play here for a little bit of a riskier one, but could yield some nice results over the years. We're gonna see that if that's too low in terms of how it's trading right now. And the free cash flow margin, again, we cannot really make it out over here because the company hasn't been making positive free cash flow, and so we're in the negative territory. And so I'm going to use something that is fairly typical, 80, 90, and 100. An annual return of 13%. I could even go more here. It's a riskier business. But let's just see what 13% yields over here. Now, if we hit calculate, you will see that our medium estimates are sitting at $3.5, our high ones are sitting at 8, and our low ones are sitting at $0.86, with our current price being at 1. Now, this implies a 10% revenue growth, a 1% net income margin. Of course, obviously, if the company ever becomes profitable, they will more than likely be making more than this. But you can kind of see here that when the company achieves just marginal profitability, it's only then when its current price actually makes sense, almost, I should say, because it's a little bit lower still. But this is, again, a scenario that could potentially happen, but the company hasn't been showing signs of it. So we haven't been seeing the company actually making positive net income since a while now. And again, this looks like it's getting worse over here. So the good thing about it is that the price of the stock is cheap. Cheap compared to what it has been, and that is, not compared to its operations, because again, remember, it's still losing money. And so if somebody actually potentially may want to get spicy, a little bit spicy here, it may be an interesting play, sort of like a lottery ticket play, though, because it's not the best investment that you could make. But it may be worthwhile maybe to just get a little bit. Now, I wouldn't go overboard with this, of course, because again, this is a very big risk here. It's a company that you buy and you understand the risks. And it's very, very different to actually be buying something and understanding the risks than saying that, okay, this company is amazing, it's going to grow tremendously, and it's going to be a multi-bagger and all that. I'm not saying that. I'm saying that, there has been so much of a downtrend over here, and the company's marginal profitabilities are close to the current price. And also the price to sales is so low that it may be a kind of potentially an interesting purchase here, to hold and wait for the long run. But remember, there are risks, important risks at that. The company is also having tremendous amounts of debt, as you will see here, a lot of debt, and will likely be, diluting shareholders even more in the future, actually. So there is potentially more to come here if the company's financials continue to be relatively subpar here. Again, it's a play that has quite a lot of risk, but could potentially yield some nice rewards, and right now it's actually even less than $1. So, it may be beneficial to have just a little bit, but I would go, again, I would go very little on this one if I were ever to buy it. So if I had a portfolio of, let's just say $100,000, maybe I would go $1,000 on this one. And probably that may be too much. Maybe I would go $500. So just a little bit could potentially make some sense over here. But again, remember, there is risks to these kinds of potential opportunities here. And it wouldn't be surprising even if the company goes bankrupt at some point. So you have to be prepared for that. And this is why if you decide to make such a play, you are actually sort of like risking quite some to make potentially even more. And this is why you shouldn't go overboard. Just have a little bit of your portfolio that's potentially dedicated to some riskier plays, and I guess indulge yourself with these ones. The ones that are at least not as bad as some others that we have looked at in the past. This one may have a little bit of a merit here. But thank you for watching. Do tell me what you think about Smile Direct Club, and remember to leave a like and subscribe, and I'll see you in the very next video. Bye bye for now, guys.